Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you an annuity versus an IRA and explain that, for dummies. And I don't wish to offend anybody with the term dummies, but, if you really want to understand the simplistic version of what is an annuity, what is an IRA, how do they kind of work in conjunction with one another, this is the video for you. An annuity could actually be placed into an IRA. So the fact I created a couple of different verse videos. The annuity and the IRA could actually be one and the same. So it all depends upon depicting what the typical IRA looks like and then why somebody would want to utilize an annuity within their IRA contract, for their benefit, for some sort of, lifetime income or some sort of safe accumulation goal, whatever that case may be. If we just hone in on the word IRA, an IRA stands for an individual retirement account. So this is something that a person can, it's a type of retirement account that someone could individualize. Simply put. What happens is an individual could have a 401k that's set up through their employer. So they're working for a company. That employee is working for a company. They're taking dollars from their salary and they're placing it aside into a type of retirement bucket known as a 401k account or a 403b account or a TSP, whatever the case may be. So the contributions that are going into that bucket are essentially growing this bucket year by year by year, but it also depends upon not only how much they're placing in there, but what is the interest credit that they are receiving within this type of bucket to determine whether or not that bucket's going to be larger at the end of the day or at the end of the year, or smaller at the end of the day or at the end of the year. So one of the examples, and so let me kind of explain what a 401k is, and then I'll explain what an IRA is, and then I'll explain how the annuity comes into play regarding an IRA contract. So with this type of concept, we understand that if somebody had 401k dollars and they were placing hundreds of thousands of dollars into their 401k account throughout their working years, and they had a downward market shift, such as in 2008, if the average portfolio lost 57%, let's just say if somebody lost 50% for easy math, and somebody accumulated $1 million into their 401k account, well, the interest credit that was determining this bucket, not only their contributions, but also the interest credit that came back, was negative that year. So then that means it didn't matter how much they've accumulated from all those previous years. If this interest credit comes back negative, or if you have negatives associated with your type of retirement account, that's a big deal. That's why individuals that originally had $1 million now only have $500,000, or somebody that had $300,000 now only has $150,000 into their account. So what it's doing is it's putting a big question mark in their retirement of saying, okay, how do I know how much money to pull out of my retirement? How do I know that the market's not going to crash again right when I need that money most? And what are some of the safety aspects, the safe strategies that I could utilize to make sure that this isn't happening with my own retirement accounts? So with the 401k, this interest credit is typically dealt with through mutual funds. Rather than with an IRA that's set up through mutual funds, a 401k through mutual funds might only give you, 5 to 15 different choices, as opposed to somebody with an IRA set up through mutual funds might be able to have 50 through 300 different choices. So you essentially just have more eggs in your basket. The problem with how IRA contracts work, so as an IRA, we understand with like a 401k, a 403b, a TSP, that's set up through the employer, that's set up through that specific entity. If you're working for the government, it's the federal government. If you're working for a private institution, that's known as a 401k account. So all of those different things have to be specifically selected, and in order for it to be offered to you, it also has to be offered to all the other employees at the company with your different funding options, with those different mutual funding options that you are able to choose. So a lot of times individuals set up a portion of their dollars into a 401k account and then a secondary portion into an IRA account, because the IRA is more individualized. It's more flexible with what types of mutual funds you want to have within those types of accounts, or what sorts of guarantees or safety that you want to have associated with that type of IRA account. So when an individual stops working for a company, they sever employment, they work for a new carrier, whatever, they work for a new company, a new employer, whatever the case may be, typically they have access to that 401k dollars that they've accumulated previously. So what you might hear of is a lot of times individuals take that 401k monies and they roll it over into an IRA contract, or an IRA account. And all that's doing is, rather than taking that 401k or that type of qualified retirement plan through your employer, rather than taking all those dollars and throwing it into your checking account, you're going to get penalized on the IRS through different penalties. You're going to get fully taxed on that money. So you don't want to go and just take the money and say, oh, this is free money, I've accumulated it. I'm 50 years old, let me just throw it into my checking account, because you're going to get dinged heavily with doing one of those types of strategies, or one of those techniques. So that's why individuals could go and they could set up an IRA type plan specific to what their needs are after they sever employment. Or sometimes when you hit age 59 and a half, certain companies allow you to take a portion of your 401k and roll them over into an IRA contract, because they understand that with IRAs there's more flexibility. You could now plan and set these up properly for your exact goal. With a 401k, you're limited to the different types of funding options that you could choose, the mutual fund related options that you could choose. Sometimes you're limited on how much the company might match you. You're limited on what types of fees are associated with that type of account. You have to pay this type of fee in order to be set up in this type of to this type of 401k related account. So there's many restrictions with the type of 401k plan that lead individuals to go and roll over their money into IRA contracts. So let me clear up the screen. So if we understand these concepts, we know that with an IRA, as opposed to a type of employer-sponsored retirement plan such as a 401k, an IRA has more flexibility. If you're looking for it mainly as an accumulation play, the IRA contract, depending upon which company you set it up with, could give you 300 different mutual fund options, as opposed to the 401k, which might only give you 15 different options. So therefore, individuals like that concept of the IRA. Now, when it comes time for retirement, typically, and this is, every day we get calls all throughout the nation that the individuals calling in, they say, I don't want to have risk associated with my account. I want to make sure that I have, X amount of thousands of dollars coming to me every single month, every single year, to the day that I die, when I hit age 65 or 62 or 60 or 72, whatever the case may be. So therefore, if you're still setting up your IRA plan like you did your 401k account, you have to understand what those negatives are, and then how to essentially deplete those negatives and make sure that your plan, your specific goals, are being set up properly. And that's what leads me into my next segment, that I want to go over something known as reverse dollar cost averaging. Because even if somebody has their retirement accounts all set up in an IRA, there's still negatives that could severely impact those IRA retirement accounts, every single day, every single year. And what we want to do is understand what those negatives are, and then eliminate those negatives, so that we could, either have that safe accumulation if you're looking to eventually leave money as an inheritance, or most importantly, that max income for either you or your spouse, you and your family, year by year by year, that you could never outlive. So with reverse dollar cost averaging, with a typical IRA that's set up with mutual funds, let's think about what these negatives are. Well, the first negatives are mutual fund related fees. The mutual funds that an individual is choosing through an IRA contract, they're not free. So therefore, those fees always have to be met year by year by year, and those fees are coming out off of a type of percentage. So if you have a 1% fee and you had $1 million into your IRA related account, well, now that's $10,000 that's going to the company that's paying for those mutual funds in order for you to be accessible to those types of mutual funds. The secondary fee is something known as an advisor fee. Typically, if you're setting up these types of IRA contracts, you might be signing an advisor, a wealth accumulation specialist, that says, hey, let me help you choose these different, these 300 plus different mutual funds. We'll go over your risk analysis, and we'll try to figure out a way on how to set up your risk tolerance properly, saying, okay, you might be a little bit risky here, a little bit more conservative there, etc. Well, for that type of advice, you have advisors are charging you on average about 1.25% of a wrap. They're known as advisor fees or wrap fees. So if we just use a very small number of 1%, we understand that your retirement bucket, if it's set up with an IRA, you already have a couple holes on the bottom of this bucket. So what are these holes? These holes are the different fees that are obviously associated there. So the different things that grow this bucket is the more the dollars that you're placing into this type of account, but most importantly, the interest credit that comes back, or the percentage credit that comes back. If the percentage comes back positive, well, then you're going to have a larger bucket at the end of the day, at the end of the year. If that interest credit comes back negative, well, then your bucket is going to be severely impacted. What do I mean by that? Well, just like that example with 2008. If that bucket, if you had a 50% hit into your retirement portfolio, now your bucket is sliced in half. And then on top of it, you have the fees that are coming out of that bucket as well. So that's just a double whammy of, obviously a bad situation if you set up your risk analysis the wrong way, or if you set up the your safety the wrong way, because it's still tied to mutual funds. And if the market wants to go down, the market's going to go down. If we have a more simplistic scenario and we say, okay, let's say the market went down 10%. Well, your account's going to go down 10%, then you're going to have to pay the advisor fee, then you're going to have to pay the mutual fund related fee as well. So therefore, you're actually having minus 12% into your account. Let's say if you go and you try to pull out money, income, you're in your 60s and you say, I want to start pulling out money from my account. I have $1 million in my 401k. And just understand, $1 million is just a simplistic, scenario, just for easy math. If you don't have $1 million in that account, that's not a problem. But just understand, if somebody has $1 million in their account and they decide they want to pull out 5%, well, this individual thought that they pulled out 5% this year. They pulled out $50,000, but they would have been dinged with $170,000 worth of value in just that 1 year, because you have to tack on the downward market loss, the income that person took, the fees, the 1% advisor fee, 1% mutual fund related fee. And now this person only took out $50,000, but they lost $170,000 of value. Therefore, their retirement account is looking at $830,000. So the next year, they're going to have to increase that percentage of income to meet that $50,000. And therefore, you have a spiral of negative aspects that could occur with these types of accounts. Very important why I'm trying to explain this to you, why I'm trying to hit home with this entire concept, because this is how an annuity could really suit your specific retirement needs to make sure that you're getting that safety aspect in it. Make sure that you're eliminating these mutual fund related fees. You're eliminating those advisor fees. You're eliminating the downward market loss, most importantly. And then also when it comes time for income, there's a specific guarantee set up through insurance companies. Only insurance companies are the only ones that can offer annuities that will provide you lifetime income for either you or your spouse to the day that you pass away. So there's a lot of different features that we could go and set up and roll over 401ks into IRA annuity contracts, or existing IRAs into IRA annuity contracts, for your particular retirement income needs or your retirement planning needs. So let me clear off the screen. So now when we're trying to understand what an annuity is the opposite of life insurance. So an annuity contract has to be set up through an insurance company, just like life insurance has to be set up through an insurance company. Life insurance protects somebody from dying too soon, meaning that an individual would go purchase a life insurance policy and that has a large death benefit that says, okay, if I expect that I'm going to live into my 80s, and I have X amount of debts, such as a mortgage, such as college education to my children, such as an inheritance that I want to leave to my family, I'm going to make sure that I'm going to stack up this life insurance policy as large as possible so that it protects me from where I am right now until I'm in my 80s where I expect to die. Something happens in the interim, well, then that lump sum is going to get paid out to my beneficiaries, and therefore they could live as if I was still there providing them, that type of income, as if I was still working or trying to pay off the mortgage or try to pay off whatever the debts may be. So this prevents an individual from dying too soon. So an annuity contract is the exact opposite of that. What an annuity does is it says, well, we're going to go, and rather than pay small premium dollars every single month to pay for this large death benefit, what we're going to do is leverage a large dollar amount to then be able to splice off smaller type income payments for an individual. The good thing about this concept is if that individual keeps living and living and living and living and living, that's what that insurance company is for, is to make sure that those payments are still going to that individual year by year by year by year by year. It prevents them from outliving their money, outliving their lifetime income or theirs and their spouse's lifetime income. So if you're familiarized with how a pension works, and you could look at the different educational videos I have out there for pension plans, we understand that individuals working for a company, right after they hit X amount of years of service, they're now eligible for X amount of, or for lifetime income payments to either themselves or them and their spouse. An annuity is more on a private sector where you're using a large lump sum, you're placing it with an insurance company. Now, it's not going to be one insurance company that you're listening to on a television commercial you saw an advertisement on. Each annuity contract has a specific niche. So somebody that's age 55 that's looking to retire at age 62, there might be an entirely different company than somebody that's, age 57 looking to retire at age 65. And that's where we come into play, is because we're associated with all the different carriers set up in your particular area. So depending upon what your state is, depending upon what your income goal or what your safe accumulation goal is, we go through hundreds of the top carriers that are specific to exactly what your goals are, what your niche criteria is, and then we have multiple proprietary strategies that on average an individual that calls our 1-800 number, 1-800-566-1002, and they want to speak with a specialist, that person is going to obviously be educated first and foremost. We're going to, make sure that you fully understand what your current plan is, if there are certain gaps within that plan, how to fill in those gaps, successfully. An annuity contract or a type of IRA annuity might suffice your particular needs. It might not. So it basically depends upon what your needs are, what your goals are. But you do want to be educated in retirement because you only have one chance to get things right. With each individual that calls our office, on average, we go through over 1,200 top carriers, products, and scenarios before we give our top 3 recommendations. And the reason why we do that, and it's something known as the Retire Sharp planning system, and the reason why we do this is because at the end of the day, it's about the individual. It's not about the company. You have companies that are marketing to all these different institutions, all these different types of independent agencies, all these different types of advisors, where an advisor may be biased towards one company over the next. With us, we want to make sure that you could squeeze out the most amount of leverage possible if you are interested in a type of IRA annuity contract. Which IRA annuity contract might suffice your particular situation best. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. That's because of the way that we conduct this methodical process. So if we're looking at the IRA versus annuity versus the annuity versus IRA concepts, the annuity could be set up for max income. You could give certainty in an uncertain world, meaning that with the insurance company would at least have the financial backing to provide some sort of lifetime income to that individual, to their exact scenario and situation. So you want to make sure it's a good rated company. You want to make sure that they have good reserve ratios, set up in their favor, so that it's a very, concrete company to be giving you that type of offering. As opposed to an IRA where we understand if you're set up with accumulation strategies only, when you're trying to do your preservation and distribution phase, that's a problem because now you have a big question mark in retirement. You have that reverse dollar cost averaging that can completely liquidate your retirement accounts and have your retirement accounts go down to $0 and have that risk of outliving that retirement money. So with an IRA annuity contract, you could be set up for safe planning, but it has to be specific. If somebody has $1 million in their IRA contracts, maybe $400,000 is the portion that you want to place into that type of IRA annuity, designated for that safe accumulation or for the maximized income planning, whatever the case may be. And now you have $600,000 that's sitting more towards those accumulation strategies, more towards that risk. But you just want to make sure that you have that safety net, you have that bottom line income that would always be coming to you so that you could enjoy your retirement years. You could live your retirement years with confidence, with either traveling, visiting grandchildren, doing vacations, just relaxing on a dock, fishing, whatever the case may be. But you want to make sure that you could set up that plan successfully, and that is a very realistic scenario with a lot of the individuals that call our office. We do have the good reviews because we try to take it at a very methodical approach to make sure that the client is always coming first, not the company. Lifetime income versus running out of money is pretty self-explanatory. Would you rather have something that is a retirement paycheck that you will be earning every single year from the time that you say, yes, I want to retire? So maybe you might have Social Security income, maybe you might have pension income coming to you, and then that third income could be, annuity type income through your IRA contracts that were already designated for retirement income. Or do you want to leverage the IRA with some sort of risky plan, risky accumulation strategies that would be subject to that reverse dollar cost averaging? So, I really hope that you enjoyed this video. I hope that you learned some things. At any point in time, make sure to give our 1-800 number a call. We have 24/7 customer service, meaning that if nights, weekends, holidays, whatever the case may be, you want to speak to a specialist, you give our 1-800 number a call. There's going to be somebody answering the phone. You say, I was watching the video online. It was annuity versus IRA. I might be interested in placing, some sorts of IRA annuity contracts with my current portfolio, and you just want to be educated a little bit further. We'll have specialists standing by. Once again, I want to thank you for watching this video. Feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thank you so much, guys.